Hello everybody, and welcome to today's video entitled The Most Undervalued Growth Stocks. This is not a video entitled The Best Growth Stocks, it's just the most undervalued, i.e. over the next 12 months, how much are you paying for each percentage point of growth? As a reminder, my type of investing is hyper growth stocks and just growth stocks in general. Because of that, most of the stocks that I follow on the channel are only optimized for gross profit. They're not optimized for earnings yet, which is why I don't use earnings. And the goal of this spreadsheet is to figure out how much am I paying for each percentage point of future 12-month out growth. How much am I paying for that? The number that's the most important to look at is the enterprise value over trailing 12-month gross profit over revenue growth. That is a hyper growth spin on the PEG ratio of Peter Lynch. Again, briefly, my type of investing is when I look at a stock, I try to look at a stock whose adoption has just begun. The product adoption of that stock, sold by that stock, has just begun. And that's when I try to get in that stock, and then I try to sell it once the stock really starts to have growth that stalls and starts getting valued as a more mature company where P's tend to be more useful. One last thing about this spreadsheet that you may find different from a lot of other spreadsheets is I use enterprise value and not market cap. The reason why I use enterprise value is because I want to penalize companies that have a lot of debt in this spreadsheet. So let me get started as I go through the stocks on this spreadsheet. First question is, which stocks are the cheapest right now? Not the best stocks to buy, the cheapest stocks right now. Well, in my view, right now, actually Lovesac, which is a stock that I don't own, but I covered recently in the channel, is the cheapest, and it's a tie with StoneCo. And I own StoneCo, and I'm very bullish on StoneCo if you follow the channel. The second cheapest one is HIMS. I still do not understand why HIMS is that cheap. Then Neobanks and SOFI are yet again a tie as far as the forward growth valuation goes. They're just about a tie. Then STEM in the energy revolution stocks. If you're looking for a cheap stock, again, not talking about the best stock, but if you're looking for a cheap stock in the energy revolution stock, STEM would be it. It's pretty cheap. And then you have Figs, which is just a very, very small position. Figs may be a company that has a lot of potential as a lifestyle brand, which is type of stocks that I follow on the channel. By the way, all of these are the different mega trends that I follow. So if you look at the spreadsheet, these are my favorite companies in each of these mega trends. Now, another question could be, what are the most expensive stocks? And to the surprise of no one, NVIDIA is the most expensive stock in the spreadsheet. NVIDIA, great stock, but I believe it's out of hand as far as valuation go, even for my tolerance. Like, I usually have very, very high tolerance on valuation. I believe that NVIDIA is kind of out of hand right now. I am still trimming Shopify. Shopify is the second most expensive stock on this spreadsheet. So let me go through each megatrend and the stocks within each megatrend. First megatrend is energy revolution stock. In this megatrend, you can see my only two tier 1 stocks, which are Tesla and Enphase. I cannot get enough of Tesla and Enphase. I love both of these companies. I do believe that Enphase is slightly cheaper than Tesla right now, but both companies have a lot of potential. And when you buy Tesla, kind of the reason why one would buy Tesla is confidence in that 20 million cars by 2030 thesis. If that happens, if that is true, you're going to have, in my view, a very hard time finding an investment that's better than Tesla if they actually achieve 20 million car by 2030, which would roughly equal to 50% revenue growth until 2030. That would be something absolutely crazy. And because of that, Tesla and Enphase are both great buys, but Tesla is obviously a stock that likely defines this decade. In my view, it's likely the stock of the decade. No investment advice. Let me move on to healthcare stocks. As far as healthcare stocks go, I love HIMS on the channel. I've made more than a dozen videos on HIMS. I think HIMS has a good role to play in the revolution of healthcare from a preventative point of view. They are a e-prescription website and an e-consultation website. What differentiates HIMSS and what makes me like HIMSS much better than Teladoc is that HIMSS operates entirely outside of the insurance system, which makes the business very easy to understand for a lot of consumers. Most of the time, the cost of using HIMSS is cheaper than copays. And Teladoc, of course, operates within the health insurance sector. And so I believe it's one of the reasons why they're having a harder time to grow. I am still adding to HIMSS right now. Now, moving on to the data warehousing and the data monitoring stocks. I'm interested in these stocks. The one stock that I prefer right now out of the bunch is actually Palantir. I like Palantir because I like it. I like the margin of safety that it has. I've also been adding to Datadog recently. On the other hand, I am completely out of Snowflake, and MongoDB, I think, because they gave such weak guidance, I think one could make a case that MongoDB is a little bit highly valued, at least compared to other opportunities like Datadog, for example. They're all obviously in slightly different sector of a data warehouse or data trend. I put them into this trend, but it's obviously they obviously have major differences depending on which one you look. I will say that for Snowflake, I've been disappointed by the literal halving of the revenue growth guidance, which is why I'm actually out of this stock right now. I have kind of a negative outlook on the stock. I was stunned by them dropping that guidance given the valuation that they had. It's still a very expensive company right now. Let me move on to my cybersecurity stocks. So Cloudflare, I love Cloudflare, right? Net is a great stock, great company. The problem with Cloudflare is that everybody agrees with me. Most people agree with me that Cloudflare is a great stock. So yes, they are a leading position. They are a near monopoly in their field. Very little competition, but they are expensive. They are expensive right now. So I'm not adding to Cloudflare right now. I've been adding to CrowdStrike and Zscaler, focusing more on Zscaler over the past few days. I think some of the drop of Zscaler over the past 2 days has been entirely unwarranted. Zscaler is the leader in zero trust. Let me move on to the e-commerce stock. So e-commerce as a megatrend is still alive and well. It's still a strong megatrend. We still have more penetration to come in the e-commerce field. My favorite in e-commerce is still MercadoLibre. I like C Limited as well, but a little less than MercadoLibre, mostly because I actually believe I understand the Brazilian market a little better than I understand Indonesia. So that's definitely one factor. The growth numbers and the margins are also better for MercadoLibre. So in the e-commerce space, my favorite is MercadoLibre. Shopify is obviously a really strong position, a really strong company. A little expensive for my taste right now. Let me move on to the payments space. So I made a video recently about DLocal, and the stock dropping 26 or 27% in one day. Well, turns out it was an overreaction because it bounced right back. So I'm waiting for a few more days to wait for it to bounce back again, and I'll probably resume my sales of DLocal. I do not think Muddy Waters is going to back down. They are a relentless short seller. I actually was on Twitter the other day, and I was seeing them arguing with buyers of DLocal with the Twitter of Muddy Waters. So it's like it's pretty relentless, and so I'm like I typically, sometimes a stock can be dead money for years, and I think it's better to get out and just move to someone who doesn't have this turmoil. And that someone for me would be StoneCo, also known as Stonier. And I believe StoneCo is a great company. They have great growth numbers, and this is a special situation type of stock. It's actually the cheapest in my universe with Lovesac. It's a special situation in the sense that the reason why Stonier is so cheap is because it's been entirely forgotten by the market, discounted by the market. They had an issue with their collateral system, the way the collateral registry was set up, and the market entirely sold them off, dismissed them. They fixed the issue, they took a loss, but the market has not come back around for StoneCo. I believe that one day it will. In the meantime, you get extremely cheap valuation for the quality of that growth. Square is another story. They also got attacked by a short seller recently, Hindenburg. So maybe this is a pattern too about payments. Maybe that's a note to take for the future. Are payment companies more likely to be attacked by a short seller? Maybe this is a pattern that we're seeing here. Anyways, let me move on to the chip makers. So I'm out of NVIDIA. NVIDIA is too expensive. Yes, they make GPUs. Yes, GPUs are essential for AI. Yes, AI is one of the biggest megatrends right now and one of the revolutions. However, that valuation, I mean, the run-up that NVIDIA had, you've had like 5 years worth of gains in a few months. So I sold my NVIDIA, perhaps a little too early, but when you sell, you always sell a little too early. I still own AMD. AMD, thankfully went back down a little bit. I thought AMD was getting overvalued too at some point last week. It went back down. I believe out of the stocks that I cover on this channel, Indie is definitely an interesting play. Although it's only a $1 billion company, Indie Semiconductors. They make parts for electric vehicle makers that are trying to compete against Tesla. One of the main dangers, though, is Indie's. My allocation to Indie would have to be smaller because it's a newer company. But the growth rate is absolutely stunning for Indie at 103%. Next 12 month estimated growth rate. So that's kind of amazing. Gross margin is almost as large as the big guys, right? Like AMD or Nvidia. So I think they have a very niche product, interesting, but of course riskier position because more specialized and younger. This company is younger and more specialized. Ad tech, I keep covering ad tech, but I haven't gotten around to it on the channel. I still prefer, the trade desk over the long run has been an outstanding stock. And I think anybody would have a hard time faulting anybody for owning the trade desk. But when I look at the more short-term lens, or at least the best buy right now lens, and I look at Pubmatic, I think Pubmatic is attractive. They have their own approach to sell-side advertising and to how they're building kind of their own type of cloud, kind of a counter positioning against the giants, which I think is very interesting for Pubmatic. Although both of these stocks are a teeny tiny portion of my portfolio, so I sleep well at night and I don't follow them too much, which is why I haven't even covered them on the channel. But I will at some point. I've covered much more lifestyle stocks on the channel. As you know, I'm interested in lifestyle stocks, which are these new brands which I view as likely to replace all of the legacy brands. A lot of the legacy brands that we have today were established through television and the evening news. And you watch the evening news and there's a commercial in between your evening news and then you have an advertising for some brand. That's how a lot of brands were created. Today, old brands, in my view, they're getting replaced by younger lifestyle brand. And so Celsius is a clear example of a brand that's going after, say, the Pepsi Max or the Monsters of the world. Lovesac is a very interesting play, in my view, in the furniture space, and so I made a whole video about Lovesac. Not a lot of people viewed it, but about what's gonna be like the way that people want to get lazy 10 years from now. Are recliners still gonna be a thing? Anyways, I thought it was an interesting play, interesting topic to talk about. And figs, then I have things in there. The problem for figs is that their revenue growth has really stalled, and so it's a teeny tiny position for me. Again, nothing to be worried about, but to buy more figs, I would like to wait another quarter and see that growth, that sales growth of their scrubs. They sell scrubs mostly for outside of the medical field now. They're trying to get out of the medical field. They're kind of following the Lululemon business model, where taking a piece of clothing that's associated with a profession or an activity and making it mainstream. But really, their sales has stalled. It may also be due to tough comps because they're in the healthcare space. So I'm holding off on those two. Celsius, I recently sold out of. I'm looking to get back into Celsius, but these valuations are just very high for Celsius too. At 30 times enterprise value over gross profit, 2021 is 30 times. It's very, very expensive in my view. But expensive, a stock expensive right now. Again, that only tells you that it's expensive right now. It does not inform you as much about long-term return, which is why this spreadsheet is the most undervalued. This spreadsheet. That's the name of the spreadsheet. The most undervalued. It's very different to asking, is the company undervalued? That's a very different question than from asking which one is going to have the best performance over the long run, I believe. Neobanks, I love the neobanks. I think both SoFi and Nubank for Latin America, I think they have it right. This is the future of banking. This is the way banking is headed. We don't need branches anymore. cash is slowly becoming meaningless to most people, and you see it today with Gen Z, who's really not into cash as much, and Generation Alpha, the next generation, they want Robux for their birthdays. I believe cash, ATMs, bank branches, all of that is not going to mean much to them. And so companies have to be apps. These banks are getting replaced by app. The SoFi app or the Nubank app, I believe, are interesting play. I have a large position in SoFi, therefore I'm not adding to it, but I am adding to Nubank. I like Nubank under $5, and it's been under $5 for a long while now. So I add to Nubank recently. And then the last category in my mega trends is platforms. I love platforms. I believe companies where you have people do tasks and run the business are getting replaced by marketplaces, or which are simply online software platforms. And to me right now, the most compelling is the Airbnb online software platform. I think there is still a lot of pent-up demand in the system, but I also think this is a secular trend. A lot of people love to stay on Airbnb. I also like the fact that Airbnb, if you travel as a family, Airbnb actually has a low-cost positioning. It's fairly unbeatable if you travel with a party of 5 or 6 people, and so I like that counter positioning. I like also that they're becoming a cultural trend. There's a lot to the company Airbnb. Airbnb, based on the number of views I get on my videos whenever I cover Airbnb, I know it's not too popular of a stock among retail investors, but nonetheless very interesting company. The beauty of the platform is the margins. Look at those margins. Airbnb gross margin is 82%, which is absolutely stunning, with still 30% of growth, and it's not that expensive. It's not that expensive right now. Airbnb, as it is a trend with innovation, they just got attacked by a short report telling that people sell outside of the platforms sometimes. Like sometimes if you have an Airbnb and you've stayed with Airbnb, you'll contact the host and try to undercut Airbnb. I'm like, we know this. This is a classic of platforms. This happens on eBay. This happens on Etsy. This happens just about everywhere. It's just the cost of doing business. It doesn't worry me at all. Short sellers at this point for Airbnb is just stock manipulation, in my view. I love Etsy. I need to cover Etsy. I haven't had a chance to cover Etsy, but I think Etsy has created a blue ocean from scratch. Like there was nothing. They came and they monetized crafts. Like this is stunning. Like for the longest time, crafts were not monetized. Now they are monetized, and so you're really creating a platform that's able to make money on, let's be frank, mostly women. A lot of women sell crafts on Etsy, and it's kind of a way to monetize that, and it's just stunning. I think Etsy has a stunning business model. They have their own disadvantages, but it's a stunning business model. Interesting company. Fiverr, I love Fiverr as well. I think Fiverr. I own just a tad of Fiverr. I should have removed that crosshair. I own just a tad of Fiverr. I want to have a little more exposure to Fiverr. I think they may bounce back, especially as we get into a world where there's more layoffs, and so more people want to get into the gig economy. They have the leading platform in that space, and that's one of the stocks that really ran up during the events of 2020, 2021, and then the stock just crashed. Like so many stocks, that pattern is so familiar. Anyways, I am done with all of these stocks. That was a lot of stocks, so let me be done. This is not investment advice. This is not the best stocks over a long-term video. This is just entertainment, right? I'm just showing you literally how I assess the price of a company and how I get to my thinking of, is this company cheap? Is this company not cheap? This is not investment advice. Appreciate all of your likes. Appreciate all of your subscribes. Thank you for watching and have a wonderful day.